Take us to our talk of the tape, whether the bulls are too optimistic on their outlooks for the markets. Let's ask one. He's John Mowrey. He's the Chief Investment Officer for NFJ Group. Joins us here at Post 9. Welcome back.
Thanks, Scott.
You get nervous as a bull. I mean, you see what's going on with rates. The market's been really choppy. What's on your mind?
Well, I think, again, you have to contextualize where we are. I mean, if you think back to October of 22, the market was trading at 15 times earnings. Today, we're trading at 19 and a half times earnings. So I think that it's very important to contextualize that, hey, the market multiple is higher. But that being said, you still got pockets of the market that are very attractively priced. And what gets me excited, Scott, is that some of the areas that are priced very cheaply, I think work in two environments. One is that the Fed sticks the soft landing and they lower rates. But the other is that we still could slip into a recession. Don't forget that we have the longest yield curve inversion, the second longest going back historically. We still could get a recession. If you get a recession, I think you're going to want a different basket of stocks than some of the leaders today in the market.
But if you're saying that we could still have a recession, the very areas that you say are cheap would be cheap for a reason, correct?
Well, I think that the reason that you have staples cheap, that you have REITs cheap, that you have utilities cheap, all these areas where the people overpaid at the end of 2022, bracing for the recession. Now those stocks are cheap, and people had a decision last year. You could buy FANG, and then you could put your money in coupons and clip yield, and so you hollowed out this whole area, Scott, of the market. So I think all those areas should do well regardless of the environment. And look, I mean, there's a lot of uncertainty always out there, but I would rather put my chips in an area where I think that you've got multiple ways to win than just betting on what's already worked.
Why would utilities do better in almost any environment, as you suggest, if rates are going to remain at best where they are now? I mean, after ticking down a lot, right, from 5 to 4 on the 10-year, they're sticky. They're sticky now. And you got people like Waller coming out today and saying, yeah, well, we may cut rates this year, but maybe not as fast. I'm paraphrasing, of course. Maybe not as fast or as soon as people think.
So the spread between the 2-year bond yield and the Fed funds rate is one of the highest going back historically, Scott. So if you look at that spread, it's very wide. The Fed is going to need to cut. I think that people are very hung up on, is it March or June? And to me, that's like if you're running a marathon, if you're like, am I going to have a water break at mile 2 or mile 3? It really shouldn't matter, particularly if you're a long-term investor. The reality is they will be cutting. And if they cut, that is going to allow other areas that have yield to be more interesting to investors relative to fixed income instruments like utilities, like staples, like the REITs. Alternatively, okay, if we go into a recession, those should do better relative, Scott. So I think for those two reasons, I would be bullish on those more defensive areas, plus the banks, as you know we've discussed, because they'll benefit as the yield curve moves down and steepens.